You've probably heard the name Michael Saylor, but have you ever really stopped to think about how one company, his company, managed to buy up a truly mind-boggling amount of Bitcoin? Well, today we are opening up his playbook. We're going to trace every single move, every bit of financial engineering that got him here.
So let's start with the big number. Since 2020, MicroStrategy has bought 638,985 Bitcoin. I mean, just look at that number. It's almost hard to comprehend. But to really get the scale of this, we need to put it in context.
And here's that context. 3.2%. That's the percentage of all Bitcoin that will ever exist, sitting on the balance sheet of one company. It's probably the single biggest, most audacious corporate bet in modern history.
Which leads us right to the big question, right? How on earth is this even possible? This isn't just about writing a few big checks. No, this is financial architecture on a massive scale. Think of it like a multi-stage rocket, with each stage designed to get more and more capital to buy more and more Bitcoin.
So here's our game plan. We're going to break his strategy down into 4 key plays. We'll start simple with company cash and work our way all the way up to these super complex high-stakes hybrids. By the end, you'll understand the whole playbook.
All right, let's get into it. Play number 1. This was the first and, honestly, the most straightforward move. Just spend the cash the company already had.
It really is as simple as it sounds. MicroStrategy is a software company, right? So they took the profits, the cash reserves just sitting in their bank account from that business, and they started buying Bitcoin. It's really no different than you or me deciding to take some money out of our savings to make an investment.
And boy, did they move fast. The buying spree kicked off in August of 2020, then another huge buy in September. By December, they made their biggest cash purchase yet, and just like that, after scooping up more than 70,000 Bitcoin, the corporate piggy bank was officially empty.
Now, the upside to this first play is obvious. It's clean. It's simple. You're not taking on debt. You're not messing with shareholders' ownership. But the downside is just as stark. You've only got so much cash. You can only spend it once. To keep this quest going, Saylor had to get a whole lot more creative.
Okay, so the cash is all gone. This is where Saylor kicks things into a much higher gear and moves to play number 2, debt. And this, my friends, is where the real financial wizardry begins. He used this really clever financial tool called a convertible note. Now stick with me here. It's basically a loan, but with a fantastic little twist. Instead of having to pay the money back with cash, MicroStrategy got the option to pay it back with company stock, but only if the stock price went up to a certain level.
The upside here was just incredible. Using this method, Saylor raised over $1 billion at, get this, 0% interest. It was practically free money that he could immediately use to buy more Bitcoin. But the risk? Whoa, the risk was enormous. If the stock price had tanked, they'd be on the hook to repay that entire $1 billion in cold, hard cash. It was a massive, massive bet.
Now we get to play number 3, and this is maybe the most powerful engine in the entire strategy. With cash spent and debt taken on, Saylor turned to equity. And what that means is creating brand new shares of his company out of thin air and selling them.
He did this with something called an at-the-market offering, or ATM. Now, this isn't some giant single sale that would spook the market and crash the stock price. No, it's way smarter than that. Think of it like a cash faucet. The company can just turn it on whenever they want, drip-feeding small batches of new shares into the market to raise money steadily over time.
This whole thing creates a classic trade-off. The advantage is you can raise billions of dollars to make the company's total Bitcoin pie much, much bigger. But the risk is for the existing shareholders. Every time a new share is created, their individual slice of that pie gets a tiny bit smaller. That's what we call dilution. But here is the absolute secret sauce that makes this entire play work. It all comes down to something called the NAV premium. It's basically the extra money investors are willing to pay for a share of MicroStrategy above the actual value of the Bitcoin it holds. You see, as long as people are willing to pay that premium, Saylor can keep printing new shares to buy more Bitcoin, and it actually makes everyone better off. But if that premium ever disappears, the whole model falls apart. And that brings us to the final act. Play number 4, the most complex, the most expensive, and absolutely the highest stakes part of this entire playbook. We're talking about hybrid securities. To pull this off, Saylor created a special class of stock called preferred stocks. The easiest way to think about these is like a cross between a regular stock and a bond. People who buy them get a guaranteed fixed payment, which is called a dividend. It works a lot like getting interest payments from a bond.
And he didn't just create one kind. Oh no, he created 4 different flavors of these things. As you can see, each one had its own funky name, different dividend rates, and unique rules. This wasn't random, it was brilliant. Each one was carefully crafted to appeal to a totally different type of investor, from the more conservative to the real risk takers. It's an incredibly complex portfolio of financial promises.
But making all those promises comes at a price. And in this case, it is a staggering one. If MicroStrategy makes good on all these dividend payments, it adds up to an annual bill of roughly $400 million every single year.
And this is where the sheer pressure of the strategy becomes crystal clear. That $400 million annual cost is way more than the $300 million or so that the company's actual software business brings in. You see the problem? That huge shortfall has to be covered somehow. It basically turns this entire strategy into a race against the clock, making the company totally dependent on a rising Bitcoin price or forcing them to sell even more shares just to pay the bills.
So, okay, we've just walked through this incredibly complicated, high finance playbook. What on earth is the lesson here for the rest of us?
Well, let's recap the plays real quick. You start with cash. It's simple, but you run out. Then you move to debt. It can be cheap, but it's super risky. Then you tap equity. It's powerful, but it waters down ownership. And finally, you've got these hybrids. They're flexible, but man, are they expensive. And this right here is the key takeaway. Saylor's playbook is built on things like leverage, debt, and extreme risk. These are tools that most of us should never, ever touch. But there is one thing we can copy, and that's his discipline. He buys consistently, whether the market is up or down. For the average person, that is the real playbook. It's about patience, discipline, and consistent saving over time.
Look, Michael Saylor is using his incredibly complex strategy to try and build a Bitcoin empire. So the only question left to ask is, what will you build with yours?